I haven't spoken to you. We haven't been on the show as we went through the Silicon Valley Bank collapse and everything that unfolded afterwards. So I want to go back, moving away from CPI numbers. What's your take on where we are today? Could we see a contagion? How worried should we be? Could those cracks become holes? Would love to get just general thoughts on the markets.
Well, sure. Well, thanks for having me on. And yeah, I think we're pretty much early in what is a greater financial crisis than the financial crisis that we had in 2008. It's pretty much the same cause, which was the Fed and the artificially low interest rates, which enabled banks to get involved in loans that would ultimately go bad. They have problems with their collateral. What happened to Silicon Valley Bank was not something that should have surprised anybody. I have been warning about it and writing about it for years. I constantly pointed out the other side of the low interest rates. Everybody kept saying, "Oh, this is so great for Americans. They can borrow money really cheap. They can buy houses and they can get these 3% mortgages, and this was really good." And I kept saying, "But what about the banks? What about the other side? They're entering into all these loans at ridiculously low rates. What's going to happen to these banks when interest rates go up and they're stuck with all this underwater paper?" That's why I kept criticizing Wall Street, because everybody was saying that rising interest rates would be good for the banks because they would be able to make more money on loans. And I kept pointing out, no, rising interest rates are going to destroy the banks because it's going to destroy the value of their collateral. And so this is just the tip of the iceberg. A lot more banks are going to fail in this country as long as the Fed continues to keep rates where they are or continues to raise them. uh, Banks are going to fail. They're just going to keep going like dominoes. The entire system is insolvent, thanks to the Fed, but also the FDIC and the moral hazard implicit with government guaranteed bank accounts. If it wasn't for the government guaranteeing all these bank accounts, customers would have been a lot more concerned about what the banks were doing with their money, and the banks would have been less likely to take this kind of reckless risk. But given the fact that everybody believed that everything was guaranteed, there was a lot more risk in the system than would have been there if we had a free market or capitalism in banking.
Uh, Peter, do you really expect depositors to understand the risk that Silicon Valley Bank was in? Because you've got experts, you've got analysts that didn't see this coming. Now, I know many people did, you did, the Fed apparently did, but didn't warn anybody. I think a report came out not long ago stating that. So, if analysts and experts that should see these things coming, how do we expect startups that already spend all their time managing their business, depositors that have a 9 to 5 job, which obviously doesn't apply as much in Silicon Valley Bank, how can they see the duration risk that Silicon Valley Bank was the trouble they were getting themselves into?
Well, again, I think it was pretty obvious. And if it wasn't for the complacency that, well, uh, the Fed's not going to allow a bank to fail, and if the bank fails, the Fed, it's going to get bailed out. I think if those more sophisticated depositors who had large sums of money at Silicon Valley Bank, I think if it was clear from the beginning that there would never be a bailout, and if the banks failed, they would lose whatever they had, they would have figured it out. It wasn't, they turned a blind eye because they were just so convinced that they had nothing to worry about because of the existence of that deposit insurance and the Fed put. I mean, maybe they thought, look, if there was ever a problem in the banking sector, the Fed's going to bail us out. The Fed's going to cut rates. The Fed's going to do QE. So we don't have to have the the normal concerns that a free market would require, because we've got the government. And it's not that you should say that it's too complicated for people to understand about banks. Banking is not really that complicated. I think there are a lot more things that are a lot more difficult to understand, like how a a television works, or how an automobile works. I mean, but people still shop around, and they can rely on consumer reports and reputations and other third party methods when consumers are shopping to buy a television or to buy a car. They should do the same thing when they're shopping for a bank. They should look for other indicators from third parties that, yeah, this is a solid bank. They've got a good loan portfolio. They don't take a lot of risk. But nobody does that with banks. Nobody puts out any alerts to consumers regarding which banks have better portfolios and are taking less risk, because no one gives a damn. No person who puts their money in a bank cares what the bank does with their money, because they know the government is guaranteed their deposit. And so capitalism doesn't work when the government interferes and does that. And so now you're counting on regulators to do the job, and they can't do the job. They're incompetent. They're incapable of doing the job. I mean, one of the things that I was very critical of for years is the Fed's stress tests. Not a single stress test stressed for rising interest rates. Not a single stress test stressed stagflation. The very thing that we have right now, and the very environment which was obviously coming, that's the one scenario that was never tested. The only thing they tested the banks for was how they would act in an environment where interest rates went down, where inflation went down. So they didn't do anything that they should have done. And it was obvious that they were testing for the wrong thing. And in fact, I think they deliberately created stress tests that they knew the banks would pass. Because if they actually put real stress tests on years ago, it would have been obvious that every single bank would have failed.
Peter, you have a lot more faith in the average person than I do, because I don't believe that a person trusts their bank because they believe they're insured. I believe they trust their bank because they think that their money is actually sitting in the bank and don't understand fractional reserve banking in the first place. But you may be correct, but it's probably a mix of both.
FDIC, everybody knows. You go to a bank, FDIC, the signs are every place. Your deposits are insured. Believe me, if there was no insurance, people would not just randomly throw their money at any bank.
Sure. So I think the interesting question here when talking about the Fed, obviously they pulled out the bazooka and effectively said they would backstop everything. What I find interesting is how utterly dismissive Powell and the Fed in general have been about their role in this banking collapse. They still continue to push the narrative that it was poor management at the banks, not mentioning obviously that the banks were limited in what they could invest in and the rising interest rates. So do you think that the Fed will continue to push here, as banking isn't really their mandate? Do you think they'll continue to push and break things at this point because they've taken zero responsibility for it in the first place?
Well, the Fed never accepts responsibility for the disasters they create. I mean, look at what happened in 2008. I mean, they created that crisis and then, blamed everybody but themselves. And the same thing is happening now. I mean, yes, it's not 100% the Fed. The government is also responsible. And, the Federal Reserve technically is not the government. It's separate. It's the Federal Reserve. But the U.S. government is also responsible, again, with the FDIC. But also, the auditors, and I guess these are Fed auditors or anyone that audits these banks. I know, from having owned a bank at one point, but the bankers need to run their banks in a way that the auditors will like. And so one of the real pressures that banks had in order to get a positive audit was to own a lot of government guaranteed investments. Because if a bank put its cash into anything that was guaranteed by the U.S. government, whether it was a treasury or whether it was a mortgage-backed security with a government guarantee, the auditors were just, yep, nothing wrong here. Let's move on, because it was all assumed that it was, excellent collateral. They didn't have to take any haircuts, meaning that the bank didn't have to reserve for the potential of loss. They didn't have to market to market, even if it went down. All they had to do is say, oh, we're going to hold it to maturity. And the auditors were like, great. But if they had actually taken that money and not loaned it to the U.S. government, had they loaned it out to a private business, for example, that loan would have received tremendous scrutiny by the government auditors. And most likely they would have applied a haircut to it based on some probability of default or loss. And so the bank would have taken a charge. And so, in order to make these audits go smoothly and to appease the regulators, the banks were basically operating in ways that they knew the regulators wanted. And that was put everything in government debt, which, of course, is not a coincidence because the government needs buyers for its debt. I mean, what idiot was going to buy a 30-year government bond at 2% or whatever they were doing? I mean, nobody in their right mind would do that with their own money. So they had to get the banks to do it. And so the regulators kind of guided all the banks into making these ridiculous investments that nobody in their right mind would do.
So I think, Peter, Peter, it's Ryan speaking. I think that you hit the nail on the head there. I think the biggest scam in this whole banking crisis was that you didn't have to mark the government bonds to market by merely saying that you were going to hold them till maturity. In any audit, the auditor, if this was not a government T-bill, the auditor would have said, you cannot make that assumption. If people have the right to withdraw the money from the bank, you cannot then assume that you're just going to hold the T-bill to maturity. You have to build in some kind of reasonable contingency, or you have to write down the value of the bonds to a great extent. And so I think the biggest manipulation that happened was that they don't have to write them down merely by stating an intent to hold them to maturity, where the intent is completely out of their hands. That's the first thing. I think the second part of the scam, there's three parts to the scam. I think the second part of the scam is Powell standing up at the beginning of the FOMC press briefing and saying, the first thing he said was, we're monitoring this banking collapse and we don't think there's a banking collapse, if I were to summarize what he said. And the scam about that is that he has no choice but to say that, because if he didn't say that, if he said, we are aware of a banking collapse and there is a banking collapse and we're going to start fixing it, they would cause a run on the banks. And right now, even the FDIC, even if it's only related to $250,000 deposits, the FDIC can't afford a bank run. And so that's the second part of the scam. And the third part of the scam is the Treasury underwriting bank deposits, because the Treasury saying that they're going to underwrite bank deposits effectively guarantees that there's not going to be any more bank runs, because investors don't need to run because the money is guaranteed by the Treasury to an extent. And so by doing that, the Fed has basically put a Band-Aid onto a massive, massive, massive wound to say, look, not the Fed, sorry, the Treasury's put a massive Band-Aid on a wound by saying, okay, well, don't worry, we're gonna backstop you guys, we're gonna backstop depositors. Forget about equity holders, we're gonna backstop depositors, and that way they create a bank run. So they create no bank run. And so if you combine those three things, to me, this is like one big scam. This is a scam. This is worse than the scams that happen in crypto, Peter.
Well, of course, the whole thing is a scam. Because of the deposit insurance, no bank can withstand a run. If there was no deposit insurance, the banks would be well positioned to withstand runs, and there probably wouldn't even be runs. But what they just did, and this is even worse, and they're going to ultimately be forced to change. But remember, when they bailed out Silicon Valley Bank, and they were asked, well, does this mean that if any other bank fails, that all the deposits will be insured, even the uninsured deposits? And the government was very clear. Yellen was very clear. The Fed was very clear that that is not the case, that the FDIC limit still only goes to 250,000. And if another bank fails, it's up to the government at that time to assess whether or not they think it's systemically important to bail out the larger depositors. So the message is, if you're in a regional or a community bank, it's just a crapshoot as to whether or not you're going to get bailed out if your bank fails. And so there is zero incentive to keep your money in those banks. Everybody now wants to pull their money out of any smaller bank to put it in a big bank, because at a big bank, it's more likely that they'll rule it's systemically important. and you'll get your money back. So they've already done something to create a run. But of course, there's going to be a run on every bank because depositors are not complete idiots. You can get 5% in a money market. You can't get anything at a bank because the banks don't have the ability to pay interest to their depositors because they were dumb enough to loan out all their depositor money to the US government for 10, 20, 30 years at 1 to 2% yields. And so they can't possibly compete with current yields when they've already locked up all their money at low yields. And so everybody has two reasons to take their money out of banks. One, the banks can't pay them enough interest. And two, there's a risk that the bank's going to fail. And so why take that risk for no reward? So this situation is going to implode. And again, all of this was obvious. For years, I talked about the irrationality of banks entering into 30-year fixed rate mortgages where they were lending money at 3.5%. I said, what are they going to do when the Fed raises interest rates and they're stuck having to pay 5% while to their depositors while they're collecting 3.5% from on their mortgages? I said it's an impossible situation. The banks are destined to collapse because of this stupid thing that they've been led to do. And it was obvious. This again, none of this requires any exceptional intelligence to have forecast. Yet everybody just remained completely oblivious to the obvious disaster because nobody wanted to acknowledge it or talk about what needed to be done to prevent it from happening.
Peter, let's assume obviously that more regional banks continue to fail or at least wobble, and we continue to see that news. What are the systemic risks of this consolidation into the larger banks that you have discussed and is obviously happening?
And by the way, just
that
before
was
Peter, just quickly before you jump in, Scott, we've got 9 minutes, I think, before the numbers drop. Is that correct?
That's correct.
Yep.
It'll drop in
Perfect.
9 minutes. And I'll have those numbers right when they
So
drop.
Beautiful. Thanks, man. Go ahead, Peter.
To answer your question, yeah, I mean, I made this point in 2008 that we should have allowed those too big to fail banks to fail back then because now they're much bigger than they were in 2008 and they're getting bigger and bigger and bigger. And this is a problem to continue to consolidate banking into a handful of institutions that will remain that are all fundamentally insolvent. I mean, all these big banks have the same problems as the little banks. They're just bigger. And so we're just ultimately setting ourselves up for an even bigger disaster when the Fed has to bail out one of the too big to fail banks because they've all made the same mistake, especially when rates have to go ratcheted up higher because so we're going to talk about inflation here soon. But inflation is not done. I mean, we're just getting started. The rates are headed much higher over the next several years, and that's going to put even more upward pressure on interest rates, which is going to put downward pressure on the value of the bank's collateral and make the insolvent banks even more insolvent. And if there's any banks that are still solvent, it'll push them over the edge into insolvency.
Mr. Karsan, go ahead with the question before we go to Evan and Caleb.
I think it's an important, that's the first time in the last 45 minutes somebody's mentioned the bigger picture, right? The reality is this isn't about the cyclical effects. Everybody's playing this in two dimensions. Yes, every time the business cycle does the same thing, we get malinvestment as interest rates go lower, and then interest rates go lower and the tide goes out and we liquidate all that malinvestment. That's not new. That is simple, as Peter said. But what's different now is the inflationary piece, the bigger picture. Why are we getting all of a sudden this inflationary kind of push? It's a simple reality. The Fed took interest rates to zero over 40 years. It was a straight line, top left to bottom right. You can look at a chart. They did that because they could, while still keeping their two mandates in line, price stability and maximum employment. What they weren't put in charge of is the distribution of wealth. And if you keep sending money to capital, what I call Planet Palo Alto, you send money to the top, to corporations, that increases globalization, that at the same time increases technological output, but it reduces wages. It reduces the power of labor in a system. And that can go on for 40 years. 40 years, about 2 generations, right? We've seen this again and again over longer time frames. But eventually, people say enough is enough. The Gini coefficient went from 0.32 in the US to 0.47. That eventually became a situation where the younger generation who is essentially labor gets to a point where they say enough is enough, and you start getting rebalancing. That's what all the fiscal policy of COVID is about. It was building politically for quite some time. Trump brought the right left, and the left went further left. But all of that movement, right, is now increasing flows to the bottom of the distribution, which is increasing inflation. And ironically, that makes other inflationary pressures stronger, because when labor is the focus, when populism is the focus, populism is local, you get nationalism, you get deglobalization, which other people have referred to on here, as well as resource scarcity. So you get global competition for resources, and all of these things are inflationary. We saw these in the 60s, we saw these in the 70s, all the same things, the beginning of a Cold War, the beginning of a hot war in Vietnam, OPEC crisis, all at the same time. We had the Great Society program and massive fiscal spending. It is not a coincidence that all the same things are happening at the same time. This is how the bigger cycle works. We can talk about the cyclical effects. We can tie them to '08, right? But at the same time, those are just cyclical small effects. The bigger picture is that rates are going higher over the next decade to 15 years. And that puts the Fed in a box, because now they have a dual mandate where they can't solve both problems at the same time. And that's the big picture.
So Peter, you said something in one of the interviews. You said, well, the US government doesn't have any money. Where does the US government get the money? From the Fed. The Fed just prints the money. That's where the FDIC gets the money, which is why everybody's going to lose. The only way the government can make sure your bank doesn't fail is by destroying the value of the money that you have on deposit. It's inflation that is going to wipe out the value of everybody's bank accounts. And you talk about this banking crisis being the cusp of a much worse financial crisis. Is there... All right, so this is the worst case scenario. What can go right? What can the Fed do? What could happen to the economy, geopolitically, globalization rather than deglobalization? What can change that would make you more optimistic?
I can't think of anything that would happen that would make me more optimistic. I mean, to the extent that something comes out of left field that I'm not thinking about, that allows us to kick the can down the road a little longer, which obviously has been happening, that doesn't make me more optimistic. Because again, the longer we postpone the inevitable, the worse it's going to be. The best thing that we could do is address the problem, even though it's now enormous because we've gone so long without addressing it and allowing it to get worse. Anything that happens that enables us to delay it again, just makes it that much worse when we ultimately can't do that anymore. So no, I mean, we've got to pay the piper for this. And the longer we wait, the bigger the bill. So
are we gonna pay it now, or do you think we'll be again? The can will be kicked down the road even further.
Well, it's again, I'm already surprised that we've been able to kick it, for as long as we have,
Yeah.
and that's why the problems are now as monumental as they are. If we would have done the right thing in 2008, it would have been bad, but now it'll be horrific. I mean, it's off the charts how bad it's going to be to do the right thing, but of course we won't. And ultimately, it's worse because, yes, we are going to destroy the value of the dollar. We are going to see a massive collapse in the purchasing power of the dollar. Prices are going to skyrocket. And the way everybody is going to lose is through inflation. Everybody is going to see the value of their savings, their investments dramatically diminished, their future standard of living eviscerated. That's how we're all going to pay for this, right? We didn't get all this government for free. There's no way out of this without suffering the cost. But the
2 minutes ago.
Yeah, the politicians do not have the integrity to admit the mistakes and come to a more equitable resolution of
I think Peter just got a call, just cut out, which is a interesting time. We've got 2 minutes left. Peter, I
One
think you
minute
just
to
got a
go
call.
now.
I'm still
The
here.
main
Okay, cool. I think you got a call. You just dropped out.
No,
So
I'm
we
still
got
here.
another minute. Any final quick words before we announce the numbers, Peter? What do you expect them to be? What's your
Well, I mean,
prediction?
well, it's hard to say on month to month. I would think that we get a hotter than expected number. But the interesting thing is that the way the markets react, because the markets react the opposite of the way they should. High inflation is supposedly good for the dollar and bad for gold, and lower inflation is bad for the dollar and good for gold. That's the opposite of reality. So I'm waiting to see the markets react the way they should. Hotter inflation being bad for the dollar and good for gold. That's
ING,
what I'm.
20 seconds to go.
40 seconds. ING predictions at 4.9%. CPI, core CPI is at 5.5%.
So the main number to look at is the month over month, which is zero point 0.4. Same for the core. And the core year over year is 5.5. So, but that will go with 5.1 for the year over year number. That should be out any second now.
All right.
4.9. I repeat, headline is 4.9.
Yeah, it came in low, 4.9%. Do we have core month over month yet?
Yeah, I have all the
core year
numbers
over year.
there. The CPI
Right.
month over month is 0.4, exactly in line. Core CPI month over month is also exactly in line with 0.4. The core year over year is at 5.5, which is exactly in line, and which is 0.1% lower than the last month's number. Everything else, other than the headline number, is in line.
Stock talk, how's the market reacting?
It's ripping. I mean, well, it's up 0.3%, but big candle off of that.
That's a big move, Stock Talk. 23%.
Yeah, I mean, it's a big. Yeah, I
That's
mean,
a
I just
huge
wanted to
move.
put it in
So
context.
I want to jump in here and give a little context to the market dynamics. We're in a generally the strongest part of the OPEX cycle, which is heading into like a week and change into OPEX. There is vol is very well supplied, as somebody else mentioned. The VIX, and implied volatility broadly is very well supplied. Generally, meaning if you don't get bad news in this part of the cycle, it's good news. You get the decay of puts. Dealers generally have to buy back their stock. Skew has been higher since this banking crisis, so a lot of put buyers out there recently because of all the fear. That creates this proverbial wall of worry in the short term and drives prices higher in the context of no news is good news.
And Peter will obviously point out gold here making a massive move up from 2029 now at about 2045. Bitcoin also heading up. Sorry, Peter, maybe to your dismay, I don't know. But basically, just
Peter,
jumped from 27.6
you just
to
got
20,
blocked, man. You just got blocked.
no, not at all. It wasn't running at all. I love gold as well. And I think,
Well, the
to be quite honest, I think all of us, I think we all agree on the premise, and it's just at the finish line where we maybe disagree on the asset, which I have no problem with.
Yeah, let me make a comment on. So the reason that you're seeing gold up, Bitcoin up, the stock market up, is that the perception is, aha, this is proof that inflation is coming down. It's not worse than expected and slightly better, right? So the numbers are lower than they were, disinflation. And so gold is going up because of a perception that inflation is coming down. And that is the wrong way to look at it, because it inflation, if inflation really was coming down, that would be bad for gold. Gold is an inflation hedge, right? I mean, you buy gold to protect you from inflation. And so if the inflation threat was subsiding, there would be less of a reason to own gold. But they're all focusing on the Fed. They're just looking, oh, if there's less inflation, then the Fed can cut rates sooner. But the sooner the Fed starts cutting rates, the sooner it's basically throwing more gasoline on the inflation fire, because the way it's going to do that is through quantitative easing. It's going to print more money, and that's inflationary. I mean, that's inflation by definition. And also, the markets still don't get it. that what we're experiencing right now is kind of the trough in the CPI numbers, that we're kind of, this is about as low as it's going to get. And the next thing that's going to happen is that we're going to turn up because the dollar is on the verge of breaking down. I mean, it could happen any day. And once the dollar cracks, that's going to send commodity prices soaring. And of course, that will immediately start showing up in headline CPI. So there's no reason for anybody to get excited by these numbers if they think it means that the Fed is winning its fight against inflation. The Fed is not only going to lose the inflation fight, it is going to surrender.
Scott, did you have further questions before I go to the panel?
You can you can
How
you can
how
go
the
ahead and
market?
move to the panel. Sure.
I'm looking at the markets as well. It's looking pretty good. Stock talk. I haven't looked at the equities yet. I'm just looking at gold. I'm looking at BTC as well. Anything new, stock talk?
I mean, it's up a little bit more than it was earlier, but yeah, equities are up pretty broadly.
Yeah.
IWM, Qs,
Wahid,
SPY,
hold on.
all up.
Wahid, have the pleasure, Mr. Faith Tribe. This is your I told you so moment. Please say I told you so and then give us your thoughts. And I'm not sure if I thought maybe you have some questions for Peter as well.
It's not a told you so. Okay. What's fascinating about this cycle, and I kid you not, because you should never say it's different this time, is this is the most telegraphed train wreck I've ever seen. It's the most telegraphed recession, the most telegraphed deceleration, the most telegraphed disparity between the different parties in the U.S. on the debt ceiling. And so it's just it's sad. So it's not a told you so. People love the four handle. Frankly, the CPI was hotter than I expected. Okay, hotter. It came in line. I thought it was going to be a bigger miss, but still, you got the quintessential 4.9er, only by a squeak, and the markets want to cheer this. I would fade this rally because now okay, 4.9 is you get into the four handle, but basically, I thought we would decelerate more on ownership equivalent rent. I'm still flabbergasted why this bloody thing is hanging in there, but I think we are gonna crater any month now. But I agree with Peter because now I'm going to be in the camp that we're going to be in the 3 to 4 range. They're going to be stuck if they lower rates, which they're going to, because we're going to have the debacle with the debt ceiling or savings and loans banks or whatever. Then basically we're going to have to start understanding that 3 to 4% is with us for a very long time. And frankly, you look at the leverage, the 700 trillion I keep talking about, the 330 trillion sovereign debt, the 220 corporate and consumer debt, and I'm talking about global here, and 180 trillion unfunded pension liabilities. That 700 trillion will never be able to be taken care of unless you have a four-handle structural long-term inflation rate. So yes, bullish for hard assets, gold, silver, and whatnot.
I think it's also important to note just quickly, and that doesn't mean it'll happen this time, but obviously the first reaction that we see to these endless PPI, CPI, choose your 3 letters or 4 letters, are often wrong in the market.
I think it's going to be
by the
wrong.
end of the day. So it's just important to note that sometimes we see a huge move to one side, which can be obviously algos or just humans reacting incorrectly, and then see it go the other way. So I don't think that just because the first 5 minutes of trading or 10 minutes here goes one way means that that's what's going to end up happening. Go ahead, Caleb.
I thought we were going to get into the 4s. We did, but not in a way that I predicted. I thought we'd get softer inflation. I'm actually not happy with the inflation numbers, but
sure. Go ahead, Caleb.
I'd like to chime in here really quick. I think, we came in below estimates. We continue to see disinflation. A win is a win. We can't overly criticize that fact, right? I was expecting 4.8, seeing 4.9. I think, again, we have to take that as a win. The thing I'd really like to highlight here is for the first time since February 2021, we had a deceleration in the year-over-year rate of change in the shelter component. This is exactly what I've been waiting to see. The shelter/OER lags housing by 8 to 12 months. We're in that window right now. This is one of my big predictions for the year. The fact that we've already seen disinflation from 9.1% down to 4.9%, while the largest component of CPI is still accelerating, has been a massive win. The big question I've been asking is what happens once shelter starts to officially decelerate? we now are in that window, and I expect to see a further continuing of a cool down in shelter and OER, which likely means that broader disinflation is only going to continue to become more powerful in the months ahead. We're still obviously way too hot. 4.9% is not an acceptable figure for headline CPI. Nonetheless, I believe we are trending in the right direction. We continue to see evidence of that. And I think, we can look at this and say, look, we're still too hot, but we're moving in the right direction. We can be encouraged by this. And I think we should certainly be encouraged about the outlook going forward, particularly given the fact that shelter now is officially cooling down, and it's it's the largest component of CPI at 33%.
The main question, Peter, is what will the Fed do with the new CPI data? And has the decision already been made? Also, why is the bond market pricing in rate cuts when the consensus is that rates will be higher for longer?
All right. So first of all, I don't think there's any evidence that inflation is receding or that it will get anywhere near 2%. In fact, looking at the consumer credit numbers, consumer credit is still off the charts. Consumers are borrowing and spending like crazy. There's been no reaction to the higher rates as far as changing behavior. So all the demand is there being created by the Fed. The budget deficits are larger than ever, the trade deficits. So all of the fiscal impetus, all the spending is there. And so prices are just going to keep on rising. And the amount of growth in money supply over the last decade, there's so much inflation that's in the pipeline you're going to continue to see the results for years and years and years as consumer prices catch up to the money supply. Owner's equivalent rent is just BS. I mean, it doesn't even exist in reality. It's something that nobody pays. While owner's equivalent rent was flat and real rents were soaring, I was pointing out the absurdity of the government pretending that there was no inflation because they pretended that rents weren't rising because they weren't actually measuring rents. So I didn't care about owner's equivalent rent on the way up. I don't care about it now. The actual shelter cost is soaring right now, not only because rents are still going up, but utilities, maintenance, insurance. I know homeowners are seeing their insurance rates double because of how expensive it is now to rebuild if your house is damaged. The materials, the labor costs are so much higher than they were a year or two ago. So the cost of owning a home is just skyrocketing. And a lot of these landlords are going to be under a lot of pressure because they have loans that are going to be maturing and they're going to have to refinance them at much higher interest rates. And they have no choice but to increase rents to try to cover their own increasing debt service costs. So yeah, I see no reason to think inflation is coming down, which is one of the reasons that gold needs to be moved much higher because it needs to be repriced for the reality of very high inflation. As far as the eye can see, it's not 2% inflation; it's a much bigger number. As far as what the Fed's going to do, they're waiting to figure out what the market wants them to do. I mean, the Fed is beholden to the markets. They're never going to be honest. I think they know they're screwed. I think they know they screwed up the economy. They're hoping they don't have to raise rates again, but they might if they feel that that's what they need to do to maintain the pretense that they're actually fighting inflation and that the U.S. economy can actually withstand the higher rates. But the reason I think the bond market is reacting is the bond market at least is smart enough. The investors in the bond market know that we are in recession and that the recession is going to get worse. The banking crisis is going to get worse. And so they expect the Fed to do what it's always done, which is cut rates. What the bond market is getting wrong is that they don't understand that this recession is going to differ from prior recessions in that it's going to be inflationary. And as the economy weakens and that puts more upward pressure on prices due to the downward impact on the dollar, that's going to be a different outcome than the bond market expects. When you have rising inflation and then the Fed cuts rates and goes back to QE in the face of accelerating inflation, that will destroy the long end of the bond market. And so I think that investors are going to get clobbered who are buying bonds because they correctly think that that we're going into recession and the Fed is going to cut because they've got the inflation picture wrong. They think a weaker economy will automatically weaken inflation. It won't. It is going to fan the fires. It's going to strengthen inflation. And that is what's different about what's about to happen from the previous cycles.
Mario, just to go back
Neely?
on this
Yeah, go
point,
ahead.
on the Fed, you're asking what's the Fed's interpretation. Just keep in mind the timing of when we get our next CPI release. It's going to be the morning of the first day of the Fed meeting, the FOMC meeting, the 13th of June. That's when they go back into session, June 13, 14. It's also a time when we're going to get an update on what they call their summary of economic projections. While they don't directly include CPI as one of their 4 key variables in the SEP, the cousin friend of it, as it were, is the PCE inflation. And that's something that kind of that they will actually put in there, but they do consider it. Powell himself has said that of course they watch it, but it will be released the first morning of the next 2-day meeting. Just want to make sure that you know that.
Thanks, Neely. I appreciate it. Gordon.
Hey guys, thanks for bringing me in. I just wanted to comment on someone who was talking about rent of shelter and OER. I think it's important to remember that Jerome Powell has been very vocal in kind of predicting this magical fall in the shelter component of CPI, which is about a third of CPI, and I think he's done that on the expectation that advertised rents that landlords are seeking for vacant apartments, the increase has dropped significantly. But I think that's a mistake. And let me explain why. It's the actual rents that tenants pay that make up the basis for rent inflation and CPI. And whether it's, Invitation Homes, who recently reported earnings, who highlighted April lease rent growth points, plus 7.5% month over month, rent renewal growth plus 7.2% month over month, American Homes for Rent, similar numbers. They said April new lease growth plus 9.4% month over month. You can look at the John Burns Research and Consulting report that came out recently, where they said that property owners and managers can command a premium for such properties, or the National Multi-Family Housing Council report that came out, where they highlighted new rent is up 8.9% year over year. The point is, Powell has been saying that this rent component is going to magically drop to 2%. Yet, if you look at what actual landlords are saying, they're still highlighting a number of 7 to 8%, which isn't where it's at right now, but nonetheless is nowhere near the 5 to 6% level that would suggest it's dropping. So if you look at the rent of shelter, 8.3 to 8.2, rent of primary residence, 8.8 to 8.8, those numbers aren't dropping. I think that has to be very concerning to the Fed, who I think was projecting that this was the area of CPI that was going to drive significant downdrifts. Thank you for the comments.
No, I appreciate it. And I'll give the mic to Jonathan. I know we've got a few more comments. We'll give it to Joseph as well. We'll have Peter wrap it up. We do have a major space based on breaking news. We had yesterday breaking news related to Trump. Today we do have breaking news related to Biden. We've got a few special guests. We're going political. Slayman will tell us what that stream that's kicking off in 14 minutes is, but it's allegations based on Joe Biden and Hunter Biden. Slayman, you've been covering it very briefly. What's the space that we're doing in 14 minutes?
Yeah, tune in. There's going to be a press conference from the House Oversight Committee Chairman, James Comer, and it's about basically Joe Biden and the Biden family's finances. We had a release from the House Oversight Committee which went through the bank details. I think that was about a month ago, but it feels like a month ago. And it looked at how the Biden family were receiving finances from certain companies in China, which may be linked to the CCP or through holding companies. So yeah, just tune in because there's going to be more revelations, some bombshell revelations.
That'll be kicking off in 13 minutes. We do have a few special guests, including a senator coming in that space. I think I was giving the mic to Jonathan. I know you've got a couple of comments and a question to Peter. Then we'll go to Joseph for final comments, and then we'll have our special guest Peter wrap up the space. Go ahead, Jonathan.
No, it's just a couple of points to reinforce Peter's thesis that inflation is going to remain higher for longer. I mean, OPEC Plus, as you said, Mario, earlier, I think they're going to call for another output reduction. I mean, the price of oil is not where they want it to be. And also the reshoring activity for the US is going to add about 20% costs. And for Europe, even more, 30% because of the cost of energy. And in the long term, energy costs are not going to return to where they were, whether you're talking about fossil fuels or clean technologies, renewables, because the commodity price, as we transition and the demand goes up, the commodity price for all of the raw materials is going to increase. And with the geopolitical tensions at the moment, that's a factor which could greatly tighten markets and obviously increase inflationary pressures.
I appreciate it, Jonathan. Joseph, final quick comments before I have Peter wrap up.
Yeah, so I just want to follow up on Peter's comment about the bond market. So just for context, guys, the bond market did not predict the inflation that we have today. The bond market was totally wrong, thinking that the Fed could not hike rates to 5% and keep it there. So the bond market has been very off right now. So I think it'd be incorrect to look at the bond prices and assume some kind of supernatural wisdom. Now, just one more addition to Peter's point is that I like to look at asset prices from a supply and demand perspective. And one of the huge changes in how the federal government is run is now that we have net issuance from the government about 1.5 to 2 trillion, basically forever for the foreseeable future. That's from both official and private sector projections. And we've never seen this before. Just a few years ago, this would have been unthinkable. And if you have basically infinite issuance going forward, obviously you're going to have prices of that decline. And that means higher yields for the foreseeable future. I agree with Peter that I don't think the market is fully understanding what's happening, in addition to the fundamental factors that Jonathan and Mario touched upon, where we have structurally changing global inflation dynamics.
Peter, to wrap up the space on a beautiful positive note, can you please tell us why you think, and you've kind of hinted at it already, but I want to kind of reinforce that question, because one of the main questions I wanted to ask you, comparing this to '08, we did have a lot of guests from Cuban to Ackman, to Robert Wolf, who comes in on a regular basis, that always point out that this is different to 2008. What we're going through now is very different to what we went through during the global financial crisis. Yet you say this is going to be significantly worse. Are you just going back to the whole printing and inflation destroying purchasing power? Is that your main concern? And is there other concerns that allow you to make such a statement?
Well, first of all, the people that you just mentioned were among the people that were completely blindsided by 2008. They had no idea that crisis was coming. They were not critical of Fed policy leading up to that crisis. They were not warning about anything in the housing market. So they were completely taken by surprise because they didn't understand the crisis. They didn't understand the mistakes that the Fed was making and how those mistakes would ultimately manifest in that crisis. Well, they're making the same mistake again. They didn't learn from that crisis. They didn't, all of a sudden figure out why they weren't able to forecast it. And so they don't understand why what's happening now is similar but worse to what happened then, because they still don't understand what happened back then and why it happened. But I think if you look at some of the other people who were also warning in advance about the 2008 financial crisis, because I was not the only one, we're pretty much all in agreement that this is going to be worse because we understood the dynamics. That's how we were able to warn about it before it happened. And of course, a lot of these people, too, have a vested interest in putting a positive spin on it, given where they're situated, and so I would take those opinions with a grain of salt, and look towards the people who demonstrated a better understanding of these problems. And of course, the reason that we had a crisis in 2008 was because we had too much debt. Why did we have too much debt? Because interest rates were too low. And when interest rates were too low, people borrowed money to buy houses. They overpaid for houses because the low interest rates pushed up home prices. And also the adjustable rate mortgages allowed people to assume payments that they really couldn't afford once the mortgages reset. And so these problems were consequential. We only kept interest rates. The Fed kept interest rates at 1% for about 2 years. And then it took a couple of years to normalize them. So we had about 4 years of low interest rates. Now we had about a dozen years of near 0% interest rates, in addition to 4 rounds of quantitative easing. So Fed kept interest rates much lower for much longer. And therefore, the economic mistakes that were made as a result dwarf the mistakes that were made prior to '08. And so when this bubble pops, and I think it already has, just the air has barely started to come out, it stands to reason that the ensuing crisis will be that much bigger as we unwind all of the bad loans and all of the consequences for the malinvestments and the poor decisions that never should have been made, but were made based on, the cheap money. So this is a worse crisis. I mean, any way you look at it. I mean, the amount of debt that we have, government debt, individual debt, corporate debt, it dwarfs where we were in 2008. So it makes no sense that this financial crisis would be shallower than the one in '08. It'll be much deeper. And in fact, I think that's the reason that nobody even wants to call it a financial crisis. The only one that talks about what's happening now as a financial crisis is me. I mean, because nobody wants to invoke the comparisons to 2008. But 2008 was a bank crisis, just like this one. Banks are financials. This is a financial crisis, but nobody wants to call it what it is for fear of the reaction.
And last question, Peter, and I know we went over time. Do we expect, or do you expect more bank failures and a possible contagion in the short to medium term?
I expect more failures, but again, I expect more bailouts. That is the problem. And yes, if the government wasn't making the mistake of bailing banks out, a lot more banks would have already failed. It's the government backstops that are preventing the failures, but they're backstopping with inflation. And so again, it doesn't matter if the government bails out your bank, you're still going to lose as a bank customer because the value of your deposits are going to go down because the price of everything you want to buy is going to go way up. And that's why it's not just that you have to take your money out of the bank. You can't stuff it under your mattress either because no matter where you have your dollars, they are going to lose value. That's why you have to pull your money out of the bank and convert it into something else. You can save it in real money. You can buy gold or silver, or you can invest it in real assets. You could do something with it. But the one thing you can't do is leave it in cash, either in the bank or in your mattress, because wherever you have your cash, it is going to be destroyed in value because of what the Fed and government are doing to prevent the banks from failing and to artificially keep this bubble from fully deflating.
Peter, really appreciate you coming on stage. I would love to have you back at a different discussion, maybe get a crypto debate. I know you're probably sick of them, but we'd love to do one with you. It's always fun. Otherwise, real pleasure to have you. For everyone, we'll be doing a space every day, as you know, tomorrow morning at 8 a.m. It's the biggest finance space on Twitter. Would love to see you there. We do have the Biden space kicking off in literally as soon as I end this one, we'll be kicking that off. It's called the Biden Bombshell Live Coverage, the Coleman release of new evidence. That will be starting in a few minutes. Otherwise, again, Peter, thank you so much for the panel. Thank you for joining. We'll see you again all tomorrow for the finance space. Bye, Peter. Thanks. Bye, everyone. See you in 2 minutes for the Biden space. Bye, everyone.